trading at its best.
Okay, welcome everybody to the weekly webinar, Forex Weekly. Just to make sure you guys are hearing me okay. If you need to adjust your speakers, get familiar with that chat box. Just type in a yes in there if everything's good to go. Okay. Okay, really quick here before we get started. I know some of you, this is your first time into the webinar, so let's introduce myself really quick here. I'm Mike Swanson. I've been trading for almost about a decade now, 9.5 years, and I've been teaching traders for about 5 of those years. So we started this Forex Weekly webinars and the blog just a few months ago. Decided to have a more consistent training, every single week. We usually do them on Fridays. Sometimes we bump it to Monday, but we've been consistently helping traders out every week. So let's do this really quick before we move any further. I have a poll I want you guys to answer really quick here. So go ahead and answer that poll. It popped up on your screen. Is this your first time attending one of our webinars? So take just a second. We've got a few options there. Make sure you read over the yeses because they're a little bit different. There's 3 different yes options there and then the no. Everybody get that done okay? Looks like only about half of you so far. I'll give you guys a few more seconds. So far I'm seeing that 55% of those of you that have voted already are repeat. You've come to more than one of these. But that's pretty good. It's pretty good that half of you are new as well. So glad to see you guys here. We've got a lot of good things we're going to be talking about today that I know will help you, can make a big difference in your trading. Just these few topics I've taught over the last couple months have helped a lot of traders out. I've had a lot of positive comments come in. Some traders have, gone in the next day and take what I taught, took what I taught and made, a couple hundred pips or made some good money off of just these basic things that we're teaching. It comes back to, the whole, sometimes, you can use the simple techniques or the simple things that you're overlooking and that can make a big difference for you. Okay, guys, well, I'm going to close that poll. It looks like it ended up about 48%. So it's about half. Half of you are saying yes, half of you are saying no. Okay, so I'll close that down, and I'm going to do actually one more, and then we'll get going here. I just want to also see where everybody's at as far as your trading experience. So answer this one really quick for me. How long have you been trading the Forex markets? If you're brand new, just got into this, for less than a month, there's an option there, 1 month to a year to 3 years, or more than 3 years. I'm guessing that most of you have been in this for at least a couple years, but I just want to be sure. I want to kind of see where everybody's at. Okay. Looks like we are seeing the majority at 1 year to 3 year and pretty close to 1 month to a year. So we do have some of you that are pretty new at this, and a few of you even said less than a month. So we have a pretty good distribution. So I always try to keep these trainings, at a level that everybody can understand and use. So, if you've been trading for a while, I'm not going to bore you to death. But also, if you're brand new to this, I'm not going to confuse you. And if I do, make sure you use that chat box, and I can definitely clarify something for you. Don't be afraid to ask a question. Nobody else is going to see your question. It's all private in that chat. Okay, so let's go ahead now. Let's take a look at what we'll be talking about today. So today's topic is scaling into a trade. So what we'll be teaching you here today is what exactly scaling in is, just the basics of what a scaled in trade is, and then we'll talk about why it's important and how it can help you. Why should you scale into a trade? And then we'll also go into the chart examples. So what I'll probably do is explain all of this through my charts. That's the way I like to do some of these topics that have money management involved in things. I think it's better to to bring up charts and explain the concept right there where you're trading. So I think that's the best way to do this. So let me bring up my charts here, and we'll go ahead and explain what a scaled in trade is, or what is scaling in. Okay, so I'm just going to bring up a euro-dollar chart. Doesn't matter what pair or time frame we're on, just need to be able to have something in front of us to explain this. Okay, can everybody see my charts okay? Okay, so let me go ahead and explain what scaling in is here. Whenever you go to take a trade, doesn't matter whether it's a buy trade or a sell trade, okay, you have to decide how much risk you're going to put on. Okay, last week we talked about calculating your lot size. So that's why I decided this would be a good topic to follow with. So once you figured out your lot size, as you know, we were saying you need to, I was teaching you that you need to figure out your stop loss and your risk percent settings and all that stuff. So you still need to know the same thing here. You need to say, okay, I've decided I'm going to risk 2% on this trade, for example. If you decide you want to risk 2%, what you will do with a scale in, so this is what scaling in is you won't take that trade with the 2%. You're going to break it up into smaller pieces, several smaller trades. So you might break it up into 4 pieces or 10 pieces. It doesn't really matter. It just kind of depends on your accuracy of your trading strategy and the style that you're using. So you might say, okay, I've got 2%. I'm going to divide it into 4 chunks. So you could take a trade with a 0.5% at 4 different price points. Okay, so that's what scaling in is you take your initial risk size, break it up into several pieces, and then you try to find those different places where you can enter those pieces. Maybe sometimes you do put it in, pretty close, almost all at once, but the idea is you want to try to spread it out so that way if you were wrong on a trade, it doesn't matter. Like I'm showing you here, if I bought right here, if I put my full 2% in, then I would have went through this drawdown and maybe I came out and made money. But if I broke it up into several smaller pieces, I'm going to end up with a better entry price, right? I'll explain what that is. That's called cost averaging. We'll show you some examples of this. So that's the basics of what scaling in is all about. Now, why should you scale in? Well, this should be pretty obvious that if you could determine, or if you could get into this trade and think, okay, I don't have to be perfect on this trade, you could add to your position. Say over here, you could add to it because now you started off with just a quarter of it or however much you split it up, and then you added to it here. You could add to it over here again, something like that, okay? And you could have your 4th and final piece in maybe on the breakout on the way back up. But what this allowed you to do was pull the trigger. Let's say you were sitting here thinking, I'm not sure if I should get in or not. Well, there's going to be times you do that. You make that decision and you're wrong and you miss a move, right? Let me give you an example of this. Let's say you're right here. Oops. Let's say you are right here in the market thinking, well, there's been a lot of momentum down. I feel like there's support here. I've got some system that tells me I should go long. And you're like, I want to buy, but I'm not sure. I feel like it might go against me, and I'm going to wait and see. Okay, so you guys wait for the move down. You say, okay, it did go down, and maybe here now you're like, now I really need to wait and make sure it's going to come back up. And then it does something like that, and in the middle of all this, you're thinking, oh man, this is just, it's going to probably pull back again. It's just going to go back into the downtrend, but then it ends up clear up there. As you guys can see, it ends up, 200, couple hundred, 300, 400 pips that day, and you miss the move. I mean, that happens all the time, right? You guys procrastinate, you worry, and you don't get into a trade because you're not sure. So this is how the scaling out helps you, is over here when you were wondering, should I get in here? Yes, you would pull the trigger, but with the smaller risk percent. A 0.5% or 0.1%. Okay, and then add as it goes against you, as you find a better place to enter, you add to your trade. So maybe you added down here on the close of that bar. Maybe you added on the way back up, and you continued to add with all this momentum. Now, you're in this move making good money, and you didn't have to be perfect. You didn't have to get a perfect entry on this trade. Okay. So I've got some questions. Do you scale in as the price is going in your direction or in the opposite direction? Well, that's a good question here. Okay, we can do both. Now, it's okay to scale in as the trade goes against you as long as you don't use it as a replacement for your stop loss. So you do not want to say, okay, I'm just going to, if you're over here buying, let's say you're thinking, oh, I'll just scale in, and you keep scaling in like this. You obviously don't want to do that and just sit here and wait till the market goes up. That's a cost averaging trading strategy, which, yes, you can build systems that successfully do this, but obviously you can see here the risk to reward ratios usually aren't going to be as good, and you're taking on some pretty significant drawdown. And the other thing is, if you do trade something like this, you still want to make sure, this is the mistake you do not want to make, is you want to make sure you're not taking on more than what the risk you set. If you said I'm going to put on a 0.5% risk, and you knew you were going to scale in like this, you need to have a massive stop out here and calculate your risk based on that. Okay? So if you thought I'm going to scale in 4 times, but I'm going to allow the market to go down 500 pips, then use that number to you can't take a 0.5% risk with a 100 pip stop and then scale in down here. You're too late. You should have already gotten out of the trade. So that's the number one thing you need to watch out for. Okay, you got to have all of this planned out, and I'm going to walk you through some examples of exactly how you would do this in a real trading setup, not just going back and drawing arrows on hindsight. So you guys know how I like to do this. What I'll do is I go up here and I turn off my auto scroll, and then I can drag back in time, okay, and I can say, okay, I'm going to hit that F12 key, and I'm going to simulate the market and demonstrate this, and you guys can watch and follow how I do this. So here we are. We're going to look at it as, okay, I'm on my daily chart, my charts. I'm going to trade with the trend. I'm looking for a pullback. I'm not sure how far it's going to come back, but I'm going to go ahead and take a trade right here. Now, someone was asking, do you get charged the spread each time you scale in? This technique does not cost you any more spread than if you took the whole trade, okay? Because you're still paying the same spread every time on each of those pieces. So you can't look at it as, oh, I paid more pips in spread because it was smaller lot sizes. If we went through the math and showed you, it would be the exact same thing as far as spread costs, okay? Okay, so yeah, so someone's saying the problem I experience is knowing what's to the right side of the chart. I went through support and you've added to the several, yeah. Well, that's why I like to do this like as if we're looking at the market in real time. We're simulating it. We don't know what's to the right. So I'm showing you as if I don't know what's to the right that I'm going to take my scale-in trade here. So I'm going to calculate how far do I think the market's going to go down before I should just get all the way out. That's your first step here. Where is my total stop going to be for all of these scaled-in trades that I take? Well, I might say, I might go look at some of my ATR indicators. I've taught you guys how you can calculate stops based on that. I might have some other techniques, but for this example, I'm just going to pick a level. Let's say it's somewhere in this congestion area, somewhere out here. That's a pretty big stop, but I'm looking at it as I'm scaling in and I'm not sure where this is going. So maybe on my my second trade, if I'm more confident, I'll make a smaller stop for that one, and that's okay. You just don't want to do the opposite. You don't want to go in here and increase your stop size after you've already taken the trade, because then you're putting on more risk. Okay, so here we are. I've taken a buy trade. I calculated I'm going to say I'm going to take 4 pieces into this. I feel like I have enough room for 4 scale-ins. So I decide I'm going to risk 2% and a 0.5% on this one, because I'm going to do 4 trades of a 0.5%. So I do my calculations like I taught you last week. We don't need to go through that here. So anyway, you've got my 0.5% in. and I've taken my trade. Next bar comes up, and it starts to head up. So I might add to my position there, looking at it as we might have a market structure low forming, you know, and looks like I was right on this trade. So if I'm right, it's okay to add even though the market went up. So maybe I added somewhere here or on the close. And again, I could either use this stop out here, or maybe now that I've seen it turn up, I might be more confident and I'll use a smaller stop. Maybe right there. Either way, I just need to calculate another 0.5% risk with that stop and stick to those plans. Next bar comes up. We get a little gravestone doji turning down, showing some signs maybe it's having a hard time breaking higher. But I'm still in profit on these trades. Maybe I'm going to wait. I could add to my position there. You know, this, I'm not going to go through all the strategy right now. I'm just giving you an idea of kind of what your thoughts would be as you're going along. Mainly trying to just explain to you guys how you do the scaling in side of things, okay? So don't pay too much attention to the actual strategy we're using here. So either I could scale in on that one. Maybe I waited it out. Maybe on this bar I feel like, okay, it's taken a while to turn down. I'm going to add to my position there. And then it really took off down here. And on that third trade, let's say my stop on that one, maybe you know, I went right around that same place. It could be the same, doesn't matter. That's all up to your strategy, which we're not really getting into that part today. So this bar turns down, and I feel like maybe that's just going to test some support. So I add to my position. Now I've got all four in, and I got most of my stops right in here. I could even bump that one up and reduce my risk on the overall trade. So now, if I were to lose on all of these, I will lose less than 2%, right? Even though I've got 4 positions in, I've went through and showed you how you would have calculated it for each of those. The worst case is I'm going to come down here and hit all these and lose my 2%. But the best part is, what if I would have sat here on this first trade and said, I'm going to put my full 2% in right there? I'd be in a worse place because, see, I've got this better entry over here that's averaging my total entry to a better price, okay? So let me show you how that would work. Here you've got, let's just make this a little different. Okay, so here you've got your buy trade sitting there at that price normally, and that's where you're stuck with it without scaling in. With scaling in, we averaged it up to there and averaged it here and then averaged it here. So we're probably in about right there on average. So this is called cost averaging. What that's doing is you're adding up your 4 prices that you entered the trade at and dividing it by 4, and that gives you your actual average entry price. So overall, I would have a better entry because of these 4 different trades I took. Now I can say, okay, let's watch how this plays out. I could decide if I want to close it early and take a smaller loss, or I can hold on to it and see if I can get through this drawdown. Looks like it might have came right down there and hit me, which is fine. Then I could enter my next trade. Let's just say for this example, so we can keep this, let's say I kept my stops larger. I mean, obviously I would have lost on that. I'm just throwing an example out there. Who knows what my real strategy would have been. But we know how the scaling out would have worked. So anyways, either I would have probably re-entered here, but let's just say I'm in those trades still, going through my drawdown. I've got my 4 positions in. I cannot add to this trade. If I add to this trade now, I'll be risking more than 2%, right? So I don't want to do that. I either want to close them out and re-enter or close out one of these, something like that, okay? Now, if we watched how this one would have played out, it would have came through that pullback, and there you go, it starts to shoot up. And then you could start to scale out, which I've already taught you guys how to do that a couple weeks ago. So if you have some questions on that example, let me know. I'll try to find another one that that maybe we would scale in on the way up, and another one maybe that we scale in even further on the way down. Just give you a couple different examples. Let's see here. You can use individual stops on every scale in. So yeah, you can choose different stops on each of these. I'm not actually sure how the first in, first out would be affected by that, with each of them having their own stops. See, I don't really trade with first in, first out limitations. I've got FinFX accounts, so I haven't really had to worry about that. But you might just have to test that on a demo with the broker you're using, Nick. Okay. Well, let's do some more examples. Clear off all these lines. Get all this stuff off my chart here. We'll just keep scrolling back, and this is how you can practice this stuff. Of course, it's better to practice it with a strategy, and you know, I could probably bring up the little simple trading strategy I taught like a month or so ago. Let me go grab. It's just a 2 moving average strategy. We use the 34 EMA, and we use the 200 EMA for the trend direction. Okay, so with this strategy, we're looking to take trades in the direction of the trend and buy the pullback to the faster moving average. Not using them for crossovers, all that stuff lags. We're using them for support and resistance and trend direction. So you guys can go back and review this blog post and the webinar replay on it. But this was called the simple trading strategy, and you can go learn exactly how to do this. For now, we're just going to you know, kind of quickly run through an example and mainly focus on the scaling inside of this. Okay, so what we'd be doing here is waiting for it to get up above these lines if we're going to buy, and then pull back to the blue line here, the 34 EMA, where there's support. Okay, so here's one way of using scaling in with this strategy. Okay, when the market comes down and comes close to that 34 EMA and then goes back up, before you would say, well, it didn't hit, so I can't take the trade. And if the market took off, you missed it, right? Well, with scaling in, that's not a problem anymore. Because what would you do here? You would take the trade with a fourth or fifth or half or whatever you decide. And that can change each time too. If you really feel like this is going to go up, just scale in with half your trade. And then add the other half if you were right as it goes up. Or if you were wrong, wait for the pullback to the line and then take the other half. Okay? So you can make that decision. You don't have to stick with a certain number every time. You don't have to break it into fourths every single time or half. You can change that up based on how confident you are in the trade, what your strategy is telling you, and things like that. So let's just say with this trade, I do go with the half example. Let's say I'm pretty sure it's going to go up, that it's just prematurely you know, didn't quite hit that line, but it's going to go up, okay? So I'll take half my trade there. So I will say, again, I'm going to say 2% on this one. So I might put my stop, let's say I put my stop below this 200 EMA somewhere, and calculate my 1% risk of the 2%, because I'm doing half, right? So I would calculate all my risk based on that, and then I will wait and see what happens on the next bar. And sure enough, it bounced up, and I was right. So I could either add to the trade here if I feel like it's going to keep heading up, or I can wait for a pullback before I add to it. Okay, so the market goes up further, then we start to get a pullback. Now maybe here I could add to my trade, or I could wait for it to hit the line, which it hit the line there, and so I could say, okay, now I'm going to add to my trade. This is if I didn't already get out here. You see, I might have already scaled out here and took some profits off too. So the idea is you want to use scaling in and scaling out together. So you could close out part of that trade there, and then when it comes back, now you have more that you can add to your trade, right? Because you've taken off some of that 1%. So now I could add my other 1% plus whatever I scaled out. Hopefully I'm not making this too confusing. Okay, let's just get rid of that and keep it simple, okay? I've got my 1% here. I didn't get out. It came down, and I add my other 1%. And at this point, I'm just going to maybe use my same stop loss. So here I've got my 2 trades in, cost averaged. I've got a little bit better entry price. Maybe I'm more confident now that it's bouncing again, that it's going to head up. Okay, it tests through a little bit, but comes back up. It's showing signs of turning up. Market starts to head up. And maybe this second time that it fails, again, I might scale out there because it's having a hard time. let's say you broke it into thirds. If you did it into thirds, there would have been your third potential entry price right there, right? So anyways, you get the idea, I think, with as far as using this technique with your strategy now. You've got this technical strategy that I've taught a couple weeks ago, about a month or so ago. Now you have now I've showed you how to use scaling in with it and scaling out. Okay, so if that keeps heading up, you take your profits, and you didn't have to be right. You didn't have to be perfect. And in fact, you could have made some money right there, knowing that, hey, I don't have to wait for it to hit the line. I'm going to scale in, and then if it does hit the line, it's okay. I'll add to my position. Okay. So let's do an example where you scale in as the trade goes in your favor instead of as it pulls against you. Let's show you the other side now. Okay. So let's look at it as there's this big downtrend forming. It's bounced off the 34 here. Let's say you already did have a trade in over here. Let's say you sold that bounce off the 34 right there, and now you're writing this out for a big move until it finally breaks to the upside. Okay, so you took your trade here. Let's say your stop was right there. You've calculated that you're planning a longer term trade here, so you say I'm going to break it into 4. So you could enter your trade here, and then as it takes off and pulls back, you could add to your trade right here, just shy of that 34 EMA. Okay, so now you've got 2 pieces in as it's going into profit. You got 3 more you can do, so here it comes back to that 34 again. So you could sell again right there. Market goes back down, now you're making more money, and it takes off. Maybe right here it came close again. You might have been able to get your 4th one in, but you don't have to get it all in, okay? Sometimes you're going to miss it, which is perfectly fine. If you've got these other 3 pieces in, and this thing takes off like that, you're still doing really well in the trade. Okay, so it's not too difficult. I mean, that doesn't take a lot of work. It's very easy to implement. You just need to do it. And I know this is an extremely valuable concept if you just use it regularly, every day. Just practice, just like I taught you with scaling out. You've got to use it consistently. You can't just play with it here and there and hope that it's going to, hit it big one time, because it doesn't work that way. It's just like your trading strategy. You've got to look at it on a long-term basis. I know if you implement these strategies and these things I'm teaching you on a long-term basis, and you give them time and you watch, how everything progresses, and you compare it to what you did before, you'll see a huge improvement. Okay, so I think that's probably enough examples. I just want to make sure I've got all these questions answered. So if you have anything you want to throw in, now's the time to do it. Otherwise, I'll probably be closing this session up. It's kind of a quick topic today, very easy to implement, but extremely helpful. So let's see, do you open a new position each time you scale in or out? Yes, when you scale in, you're opening a new position each time. Okay, let's see, do you try to make one for one or a higher risk to reward on every trade on scale-in? Well, that's up to your strategy, really. It's not really, there's no specific way to do the scaling in, I guess. So, one trader might scale in very quickly. He might scale in every 5 pips, really tight and just close together to try to just make a few extra pips on his trades. Other traders might give it a lot of room and be happy that, be okay with just getting 1 or 2 of their 4 trades in, or however much they break it up. They look at it as more of a risk management strategy, and so that's really up to you and how your strategy, your following works. I do suggest trying to overall have your risk to reward 1-to-1 or better. So if you say, okay, on these 4 trades I've shown you here, your plan all along was to risk no more than 2% total. Well, that would have been, if your stop was up here, so you'd have to be averaging about, between all the trades, about 281 pips to get 1-to-1. And you easily got that. I mean, this thing went 700, 1,000, 1,500 pips. So you got, if you did that right, you would have been easily over the 1-to-1. Do I recommend using this strategy on a daily time frame? And can I see this strategy somewhere on a recording? Yeah, I definitely suggest this, using this on a daily time frame. It works on any time frame, but as you guys know, especially with Forex 3D that I'm teaching lately, is I prefer the daily charts because you don't have to babysit the trades. I mean, if you're on a 15-minute chart or an hourly and you miss these things, and you miss these bounces, it's just you can't be there 24/7. Where on a daily chart you can be there every day. You can check on it once a day and see if it's at the level or not. So if you want to learn this strategy, you can go to our YouTube channel. You can probably have Ramin post that link in the just to everybody in the chat. But you guys can go to our YouTube channel or look out for our emails. We always send the replays of these usually by Monday. So you can go back and watch these replays, or you can go review the blog. We're looking to make some changes on the blog where what we do is instead of doing the blog right before the webinar and then giving you the replay on Monday, we're looking at taking this approach. We'll let you know about the webinar, do the webinar, and then give you the blog on Monday with the replay. So you can just get the summary and the blog on the actual, or the replay on the actual blog. I think that'll be easier for you to find everything in one place. And so we'll probably be making some changes. So just look out for an email from us about those details in the next couple days. Yeah, the past training webinars, like I say, right now are on our YouTube channel. Ramin just posted that link. And like he said, you can subscribe to our channel and you'll get all the updates. So when we add the replays, it'll notify you. Edward, as far as getting charged a spread on each position, let me get a little notepad up here and demonstrate this for you, okay? Let's say you normally take a trade with one lot, and it's at 1.3500 with a 2-pip spread. Okay, here's what you have to do to make this make sense. You've got to see, what did that spread cost you? Well, on a standard lot, 2 pips is going to be $20, right? That's what that spread cost you. Now, let's do the example. Let's just say, let's keep it really simple and show you I broke it into 2 pieces of 0.5 lots. And say I did my first one. It doesn't really matter the price, I guess. So I bought the first one at 3,500, and I bought, or sold, doesn't really matter here, 3,500 or 3,505. Okay, it doesn't really matter the price. I probably shouldn't even put that there, but I think you get the idea. So let's say it's still a 2-pip spread. What does that cost me? Well, a half a lot is $5 a pip times 2. That cost me $10. So what did that mean? What does this mean here? This means that it's the same exact cost, right? Oops. Okay. So yeah, I paid the spread on each trade, but it doesn't matter. It's adding up to the same as this total trade. I could do this into as many pieces as I want. I mean, this would be $1, right? And if I did this 10 times or 20 times, I'd be at $20. Does that make sense, Edward? You just don't look at it as it's costing you more pips, because like I've always taught, a pip doesn't really mean anything without the lot size component. The lot size is what shows us here that it doesn't matter. Okay. Let's see. Can small accounts use this strategy? Yeah, definitely. And I'm going to be teaching that topic actually in the first Forex 3D coaching session next week on Wednesday. So those that join me I'm going to be teaching all about account setup, so you can get your account, even a small account, set it up so you could have a 500 pip stop on a trade. You could take 10 scale-ins and be perfectly fine without putting on a lot of risk. I'm going to be showing you how to do that next week. Let's see. So if you guys want that link, you could just go to, let me just post that for you guys here for Forex 3D. I don't know, hopefully you've been getting those emails from us about that, but I'll just post the link. Okay, so I just posted the direct link to the Forex 3D. You can learn more about that there. Let's see. I know we are getting ready to close that up because we are starting the training next week. We just had the welcome webinar on Wednesday, and we're starting the training next week. Let's see. I may have missed it, but do you place the stops on the other side of the long-term MA? I was jotting down some notes. Glenn, on that, I didn't really teach that today. I can't remember if we talked a whole lot about stops even in that simple strategy training. You might have to review that. But if you want to know where to put stops, I suggest you go review the blog post on, let me just bring up the blog here for you guys. You can kind of see what we're talking about. Okay, so it's just tradewestforex.com/blog, and you can type into the search and find the different topics. You know, you could type in stop loss, and we have this, should I use a stop loss? So here, we teach some different things about stop losses. You can review it all here, but you really need to go watch probably the webinar replay. And like I said, Ramin gave you the link to our YouTube channel, and I'll go there and show you real quick where you'll find that. Let's see, let me just click that same link right there. Okay. So here you go. You go to youtube.com/TradeWestForex, and you'll see here is our last webinars that we've uploaded. Okay, so we've got, here's the scaling out. You can click that one and learn about the scaling out, and then it loads up all of the similar ones over here on the right. So you can see trailing stop, you can see how to determine the trend, all kinds of stuff. The stop loss one is in here. There's the simple trading strategy that we're talking about. So that's where you'll find all this stuff. I suggest you just, spend the weekend going in and learning from these different recordings and topics I've taught on. So it's all free. You can get in there and learn quite a bit. So that's where you'll learn about the stop loss, Glenn. This is only true if the second currency in the pair is the same as the account currency. Let's see. Well, yeah, as far as account currency and the trading pair currency, you can go in and make the adjustments. For example, the euro pound is going to be different, right? I know what you're talking about. Let me bring up that notepad again. So yeah, I kept this simple, a 2-pip spread, a standard lot being $10, 20 pip, yes, $20. So yeah, that's based on dollar-based pairs. Sure, if you've got the euro pound, the euro pound is going to be a different pip value, and you're just going to make sure you adjust your lot size according to that, right? But it all comes out the same. And I haven't taught on this yet in the Forex Weekly. We actually did a lot of this in the Forex 101 sessions, so you might just want to review those. Okay, yeah, this webinar was recorded just like all the others. We'll most likely send an email out. I think Monday we usually send that out. and we add it to our YouTube channel as well. So if you are trading micro lots and scaling in, do you really need stops? I get stopped out too much. Well, you still need to have stops in place, because otherwise, here's what's going to happen. Okay, you're going to be, let's say you were on the opposite side of this. Let's say you were buying on each of these. If you let the market just keep going and going and going, you know, you're eventually, you know, you're going to lose 1,500, 2,000 pips on the daily chart here, and that's okay if on the other side, when you win, you're letting it go 1,500 or 2,000 pips into profit. So it just comes down to having good risk to reward ratio, and you'll be okay with that. But otherwise, I just suggest you still stick to stops. If you find yourself getting stopped out a lot, that's fine. Just make sure when you win, you make it count. That's another topic I'm going to be teaching. I think that's in week 4 in the Forex 3D coaching. I'm going to be teaching how to hold on to the big winning trades and how to cut the losses short. And it's fine if you lose 50%, 60%. You can lose 60% of the time and make money. You just have to make sure you're making those winners count. The two EMAs I was showing you here is the 200 EMA and the 34 EMA. I have a trade showing 210 pips on the chart but only 170 in the money. Why? Well, that might be because you're probably on a 5-digit, 3 and 5-digit broker where they quote a pip as really a tenth of a pip. So see, even this little counter with my crosshair is counting it as, you know, the 3,000, 10,000. It's not 10,000, 12,000 pips. Because this is a 5-digit pair and broker, they are they're showing tenths of a pip. So really that count right there of 12,546 is only 1,254 full pips. So what you're probably seeing is 21 pips profit on the chart and 17 pips in the money, and that's because of spread. Your spread's probably 4 pips. I mean, I'd have to see exactly what you're looking at, but I'm guessing that that's the discrepancy. So yeah, that's the idea, Rob. You keep your losses small, which means, yeah, you're going to get stopped out more often, but when you win 2 or 3 times what you lose, you only have to be right 30 or 40% of the time. But that's for a different topic. I think we might have even covered risk management. You talked about scale or risk to reward ratio. And Nick, on that, I would just review the simple trading strategy webinar replay on the YouTube channel. Well, guys, I think we're out of time for today. I hope you guys enjoyed what I taught today. I thank you guys for coming to these webinars and taking the time to go through these trainings. I know it will, make a huge difference if you just implement these simple things that I'm teaching. So thanks once again. We'll get this replay out to you guys so you can review it. I hope you have a great weekend and take care.